Let's focus, though, on the sector of the day yesterday. That was Pharma. The markets ended lower, but the Pharma sector was up and about. To help us out with a quick analysis on that front, we're joined by Aditya Khemka, the fund manager at Incred Healthcare PMS, who joins us on the show. Hi, Aditya. Happy New Year. And it appeared it was a very good start to the year for the Pharma stocks yesterday. What's your view? Do you believe that the worst in terms of pricing is behind? Will things look up from here on? How do you see things shape up?
Hi, good morning. Happy New Year to you and your viewers. The rally that we saw yesterday, to my mind, had very little to do with price erosion in US. The pricing pressure that we keep alluding to is largely related to the US market for pharmaceuticals. The data that we see coming out from various agencies still indicate that pricing pressure remains elevated. It remains between mid-single digit to high single digit, which has been the long-term averages. It has cooled off from low double digits that it was, let's say, a year back, but the pricing erosion still persists at a mid-single digit to high single digit. So the rally is not really linked to any improvement in the base business in the US. The rally may be linked to certain, large ticket launches that some of these pharma companies have done in US, for example, Revlimid, for example, Spiriva. But these are 2-3 year cash flows. These cannot be extrapolated to 20-30 years. Remember, most of these pharma companies trade between 35 to 40 P multiples, which implies that the cash flow they are making today should at least last for 35-40 years. But these large ticket products that they have launched in the US are going to be 2-3 year cash flows, not longer than that.
Since we're talking about multiples, Aditya, the EV to EBITDA for many of these pharma stocks, right, on an average, trading at about 25 times FY23, if you look at it. The historical 10-year average is about 18 times. So would you be concerned about the valuation picture, or do you think that earnings are picking up in tandem with valuations and these levels are justified?
Yeah, look, the fascination that most investors have with multiples like EV, EBITDA, and PE is slightly misplaced in the sector right now. The reason being that the last 12 months of FY23 specifically, the cost of the raw materials was significantly elevated because China was not producing chemicals as much as they normally produce. And because of that, the price of raw materials was extremely high, and the margins of these pharma companies across the board were fairly suppressed. Now, when you take EV/EBITDA, the denominator itself is the last 12-month profit, and if the last 12-month profit is suppressed, your EBITDA multiple looks slightly higher than it should be. Remember, multiples make sense only when the profit is in steady state. When it is inflated or deflated, EV/EBITDA or PE multiples do not make much sense. So yes, the multiples do optically appear high, but as you said, the next 12 months, which is FY24 and maybe even FY25, we expect that the profit will grow much faster than the top line because China is now producing full steam and the price of the raw material is declining, which will help these pharma companies to expand margins. And therefore, I don't have a discomfort with the valuation multiples that we spoke of.
You were also talking about Revlimid generic, right? That launch has aided the US sales for a lot of companies, whether it's Cipla, Dr. Reddy's, Natco, Sun Pharma as well. But some of these stocks like Cipla, for example, are sitting at fresh 52-week highs. Do you think the good news is already in the price, or could there be more to go because of Revlimid generic?
So I think Revlimid generic is largely in the price now. I would say it is actually overappreciated than what it should be. Remember, Revlimid is a 3-year cash flow. Sometime in 2026, Revlimid goes generic because the patents expire. But the cash flow that they're making today from Revlimid is probably getting a multiple of 35-40 PE multiple, which to my mind is a highly inflated multiple for a cash flow that is going to last only 3 years. So yes, I think Revlimid and more is in the price today. And for some of these stocks, especially benefiting from large product opportunities in the US, the stock seems to be priced higher than their intrinsic value.
Okay. By the way, just coming in to point out that there are some interesting moves in the pre-open. The Nifty is very quiet and so is Bank Nifty. All the indices are flat. Look at the excitement that is already reflecting on the Adani stocks. In the pre-open, all Adani stocks are rallying. Adani, Total Gas, 8%, Energy is up 10%, Green is up 6%, Enterprises, Sports, Power, everything. The entire Adani group is up and about. That's one interesting trend. The other one is check out VST Industries. Now that we have confirmation on who the buyer was in yesterday's block, and that is Mr. Radhakrishnan Damani, the market's quite excited. In the pre-open, the stock is getting bid up another, it was 10%, okay, now 6%. So that was the other interesting mover. But otherwise, I mean, it's very, very quiet out there. Hero Moto suggesting a decline of 1.5% because those numbers have been pretty dismal, as Sonia pointed out earlier. So those are some of the early indications and trends from the pre-open. But Aditya, just to come back, I mean, if I were to ask you, what is the biggest trend in the pharma space, frontline pharma space, that you'll watch out for this year? And maybe, even in terms of product launches, is there any one or two blockbuster drugs like a Revlimid, which we had, last year, which could be sort of the defining turning point of 2024 for Indian pharma?
No, so unfortunately, we do not have any visibility on any large product launches in 24 or 25 for most of these pharma companies. There might be a couple of launches here and there, which would be very company specific and maybe 6 months cash flow or 3 months cash flow, depending on the kind of exclusivity that they have. But by and large, there are no large ticket launches happening in the US business for majority of these pharma companies, which is why if you see as a house, as Incred Healthcare portfolio, we are not taking any exposure to pharma companies that have a large exposure to the US business. We are rather more bullish on companies which are branded generics, which means focusing on India and emerging markets, hospitals, diagnostics, and even API companies. So the trend that I see happening in the next 12 months, which will basically help investors to make money, is to focus on companies which have brands, which have sustainable revenue, sustainable cash flow, high ROEs. And these companies will also benefit from softer input costs that we, these companies saw elevated input costs last 12 months. So the next 12 months, they'll see, softer input costs, which will help them expand margins as well.
Okay. Quickly, diagnostic companies you briefly mentioned. You think the worst is over in terms of pricing pressure, competition, etc. for diagnostic companies?
Yeah, I think that's a slight misperception that there was ever a pricing pressure in diagnostic companies. Yes, there were competitors who launched at cheaper prices. That was a customer acquisition strategy, sort of cost. And I think those online platforms also, if you go back and check their prices now, they've increased prices manyfold. And they're still at a discount to the incumbents in terms of the traditional brick and mortar players, but the discount has now significantly narrowed to what it was when these online players had launched. So yeah, I think diagnostics will remain a very, very secular growth story. The incumbents will continue to grow at their own pace. In fact, just to let you know, incumbents have actually increased prices after the online platforms started offering this test at a discount. And the incumbents continue to grow their revenue in a high single digit to low double digit, depending on which incumbent we talk about. And we feel that diagnostic is a branded play. 85% of the market is unorganized. So any new player which comes is very unlikely to challenge an incumbent and rather take market share from the unorganized sector. And diagnostics as a sector has significantly derated post-COVID. So, it's a combination of where, earning growth is going to be solid, margin expansion is going to happen, and multiples can probably re-rate. So we are very, very bullish on diagnostics.
Okay, bullish on diagnostics. Got that. We'll end on that note. Thanks a lot for joining in. Appreciate your thoughts here.